Good afternoon, ladies and gentlemen. Hope that everyone had a fantastic weekend. This is Robert Rayburn here at Life Pro Asset Management. It is August 26th of 2024. And, certainly the big theme around this week's update is going to be the big pivot that the Federal Reserve is making from a higher interest rate environment to a lower interest rate environment. So we're going to be answering the key question of why that's important, why it matters to you, and how we're making adjustments to your portfolios in response to this big shift that the Federal Reserve is making. So let's go ahead and get started with the presentation. Now, the title of this week's presentation is that the Fed moves to cut rates. Now, it may not be the most creative title in the world, but really we want to spend a lot of time this week on that. It is important after 2 years of really 3 years of the Federal Reserve increasing interest rates quite dramatically in the most rapid fashion in the modern era. We're now getting to a point where the Fed believes that they've largely won the war on runaway inflation. Now, we haven't had deflation to offset those price increases, right? I don't think the Fed actually wants that, but we've gotten back toward that 2% target. As a result, the Fed is shifting away from its war on inflation, now saying we're going to focus on employment and stabilizing that slowing growth in the economy. So 3 big things this week. What happened at Jackson Hole? That's where the Federal Reserve holds their annual retreat. And why does it matter? Number 2, what does inflation suggest about interest rates? And then, of course, what are some of those key themes moving forward in this lower interest rate environment? As it relates to Jackson Hole, so what were the big takeaways from Powell's speech? So if there's one sentence here that I think says it all, it's that first sentence, which is the time has come for policy to adjust. Translation, it's time to cut interest rates. Now, it's one thing to say you're going to cut interest rates once in September, but it's the second sentence that perhaps is more important for the equity market as a whole and for the bond market as well, which is the direction of travel is clear and the timing and pace of rate cuts will depend on incoming data. That is Fed parlance for not only are we cutting rates once, but it's going to be a campaign of lower interest rate cuts over the coming months and years. And then the third most important thing, and actually, not the third, but the third thing, perhaps the most important thing, was what the head of the Philly Fed, his last name Harker, said about Fed policy, which is it's pretty obvious that we want to get back to the neutral rate. Now, this is an academic term. The neutral rate is this hypothetical interest rate that neither detracts from economic growth nor adds to economic growth. It's purely hypothetical, right? No one really knows what that rate is, but it's important to understand what the Fed thinks that rate is, because that allows us, at the end of the day, to understand how far down interest rates could go. And what Harker said on Friday was that he believes that, and the Fed believes that neutral rate is right around 3%. So right now we're at 5.5%. That implies about 250 basis points of rate cuts. And then on average, you're going to get about 25 to 50 basis points per meeting of rate cuts. So we're certainly in a zone where we're likely to experience significant rate cuts going forward. Now, again, the economy could adjust, inflation could reaccelerate, and that goes all out the window, right? But as of now, that's how we're trying to pivot the portfolios, and that's the world we're trying to understand. Now, it's important to also know that the markets don't wait for the Fed to move. We can see here the chart on the left, the 2-year interest rate has already started to price this in. You're starting to see it priced in as it relates to car loans. 30-year fixed rate mortgages have come down almost a full point, despite the fact that the Fed technically hasn't even made a rate cut yet. And you're seeing it, HELOCs, everything. Those rates are coming down across the board already. That should act as a stimulant for the U.S. economy to offset some of the slowing growth that we've seen over the last 3 or 4 months. And so when we look at the spread between the Fed funds rate and the 2-year rate, it's near a record 135 basis points, which means we believe the Fed is probably going to move pretty quick to close that spread so that they're in line with what the market is currently pricing in. The other big thing is to understand why rates are going down and how they're going down. You certainly don't want rates coming down like they did in 2008 in response to a 2008 type of situation. That's not where we want to be, right? That's a panic. The way we look at that is we look at symptoms in the market. What's the market trying to tell us, right? So we see the 10-year yield is breaking down, moving lower, obviously in anticipation of lower Fed rate policy. But the other interesting thing is that the US dollar is also breaking down. Now, in pure academic terms, this makes sense, right? Lower interest rates implies a lower dollar strength. But if interest rates are coming down because people are panicking and the Fed is panicking about the Fed falling off or the economy falling off a cliff, then you tend to get this rush, this panic buying of US dollars for safety. That's not happening. People are actually selling US dollars. So that tells us that underneath the surface of the hood in the market, there is no bubbling panic that's taking place, because typically during a panic, people rush to buy US dollars, not sell US dollars. So what does all this translate into? Rate cuts, right? So right now we're at a 5.5% current policy rate. Through the Fed's comments, through the weaker economic data that we've seen over the last few months, in particular the slowing jobs market. And we've also, obviously, one of the big news items last week was the fact that the federal government announced that some of their jobs data was not accurate. And there was about 800,000 fewer jobs created over the past year. So that goes into the Fed calculus as well. And then we look at what the implied neutral rate is, which is 3% according to the Fed. So that really tells us we're going from this environment where we are shifting from 5.5% on a glide path towards 3. Now, what happens between 5.5 and 3 and how fast do we get there? Who knows, right? That's guesswork. But we do believe that this is the likely path that we're on over the next year or two. So what is the impact of lower rates? First and foremost, for everyday Americans, that is going to likely result in lower mortgage and loan rates across the board, right? So mortgage rates are largely priced off that 10-year interest rate. That 10-year interest rate has broken down way through 4%, is now in around that 3.8 mark. So you're likely to see those mortgage rates continue to fall and reprice lower. Number two, loan rates, credit card rates, all those types of things are going to reprice lower, obviously acting as a stimulant, not just for the housing market, but also for the broader economy and companies that have a lot of debt on their balance sheets and the ability to reprice that debt at a lower rate. That's obviously a good thing for those companies, or a good thing for a lot of families that may have mortgage rates in that 5, 6, or 7% range. So that's a big area that will benefit. Definitely benefits smaller and higher growth companies. So what we saw in 2020 is that a lot of growth companies outperformed in the stock market. Why? Because a lot of their market value was based on growth way out into the future. So if you have lower interest rates, you value that growth way in the future at a higher present value versus if you're in a high interest rate environment. So you'll notice some of the portfolio changes that we've been making is to anticipate this idea that if rates are coming lower, you're going to see a rush out of the Magnificent Seven companies that everyone's been concentrated into and into the mid to small cap growth companies. And that's really where we're starting to focus a lot of work on. We talked about this before, helping companies with lots of debt, and then where we really think small cap, emerging markets, growth stocks outperform value and defensive stocks. Overall, right now, the breadth in the market has been holding up. So despite that panic sell that we saw early August, late July, what we did see is that overall, the percentage of stocks above their 200-day moving average stayed above 70%, and right now is around 77%. Again, this is a symptom of a healthy market where a lot of stocks are participating in the rally. You're not getting a super concentrated rally in just a few stocks. Where we're seeing it even more so is in the Russell 1000, right? So this is your 1,000 largest stocks on the NYSE. And what's interesting about that versus the S&P 500 is that the advanced decline line, so advancing stocks versus declining stocks, hit a new high. And why that's important is that we have been in this concentrated market where a lot of the year-to-date performance has been concentrated in those top 7 names. We're now starting to see returns get more evenly distributed to the rest of the stock market. And that's, again, where we're positioned and how we've been positioning the portfolios over the last few months. We think as that repricing takes place, it'll happen very quickly. And this is this idea of the democratization of returns, right? So if we look at the NASDAQ 100 versus the equal weight S&P 500, the equal weight S&P 500 has broken out to new highs. Meanwhile, the NASDAQ 100 is actually starting to struggle a little bit. And the reason for that is the NASDAQ is heavily concentrated in those top 7 names. Underneath those top 7 names, the NASDAQ actually looks pretty good, right? Because a lot of those companies, whether it's you're talking mid cap, small cap software, or if you look at fintech names, which we've recently started to put money to work in, a lot of these companies did not participate in the rally for the first 7 or 8 months, got hit in that July, August sell-off, and now are very attractively valued. And the market's now starting to anticipate a significant period of lower interest rates. So bottom line is, that's good for the equal weight S&P 500 versus the cap weight, which leans toward the top of the market. So as interest rates drop, you may no longer need to pile into those same 7 stocks to generate attractive rates of return. And we see that in the way that some of these top stocks are behaving, right? So Microsoft, Google, AMD, Amazon. What you can notice here is that while the market has returned to highs, Microsoft has not. Now, has their business deteriorated at all? Absolutely not. It is still a fantastic business, and we want to be very clear about that. But the stock is starting to struggle, right? So we look at the relative strength of Microsoft is starting to fade, and that has leaked into the price action of Microsoft. Same goes with Google, right? Significant sell-off has barely bounced despite a very significant market bounce. Amazon, AMD, both very similar to Microsoft and Google. So again, when we think of the market right now, it's not only we positive, but we also think that the composition of and distribution of how returns are being generated is going to change. And this is a big reason why. So what's that lower rate playbook that we keep talking about? Well, obviously, we are positive on digital currencies right now, such as Bitcoin, small caps, regional banks, commercial real estate, which is more in our REIT playbook. We look at M&A. We do believe merger and acquisition activity will start to increase. We do know that there's certain private equity firms right now that have quite a bit in capital that has piled up over the last few years, and they're starting to put it to work. Energy, not so much, right? Because again, we're going into that slowing economic environment, and healthcare tends to be more of that defensive play. Now, within healthcare, Bitcoin does tend to, or sorry, Bitcoin, biotech tends to outperform in a more cyclically driven type of marketplace. So the bottom line is, Powell and the Fed are preparing the country for lower interest rates. Now, from a psychological hurdle perspective, a much easier hurdle to prepare people for cheaper money than for more expensive money. That said, there are risks with that as it relates to inflation coming back. So we want to keep an eye on all those things. But it also changes how we want to look at portfolio management and what we want to be invested in. Number 2, we need to adjust for a lower rate environment, and we need to consider assets that potentially benefit from those lower interest rates. So if you notice that we're pivoting the portfolio, it's because the environment's changing. The Fed's telling us that, and we don't want to fight the Fed. And number 3, market breadth is expanding and credit spreads remain tame. That, to us, tells us that we're going to this disinflationary soft landing that's not necessarily accompanied by a recession. Now, if recession risks start to rise, we will adjust again, if that is the case. But that's what we got for you this week. 888-543-3776. Thank you for all your time and your attention. And please, if you have any questions, reach out to your advisor, reach out to us. We're here to help. That's what we do. And we're more than happy to answer any of your questions. In the meantime, have an absolutely fantastic, safe, fun week, and we'll talk to you soon. Bye.